So, welcome to the participants and our our guest speaker today for this KSCAA Shorts. So, today's topic we have is recent changes in income tax return, and we all know how important income tax return is because the additions which are made in the assessment during assessment stage, or the penalty orders or the prosecution, everything has some kind of connection to the income tax return. So filing a precise and accurate income tax return is a very important step in every consultant's association with the client, right? So these changes, the changes which are made to the income tax return, as practitioners of income tax, we need to understand the impact of these changes, as well as we need to foresee what information we need to seek from the client so that we are well prepared into our tax filing season. So with that intention, we are hosting this KSCAA Shorts. Okay, so we have for our speaker today, we have CA Ashish Jain. CA Ashish Jain is an associate chartered accountant and currently employed with JCSS as their direct tax manager. He has a post-qualification experience of more than 5 years in the field of direct taxes and international taxation. He has previously interned with Dariwal and Srinivas & Co. He has gained vast experience in various aspects of domestic and international taxation. He has advised various multinational companies across a wide industry and value chain spectrum on a variety of aspects, including efficient tax structuring, tax clearances, and compliances. Ashish was a winner of the recently concluded IT-80 Moot Court competition held by KSCAA. Okay, so over to you, sir.
Thank you so much, Abhishek, for the kind words and the introduction that you provided. So firstly, I would like to thank the whole team of KSCAA for providing me this opportunity to present on the very important for all of us to understand and to know the key changes that have been introduced in the ITR by the CBDT. This will help us to basically address the filings and make appropriate disclosures in the income tax returns that we have. So to begin with, the ITR forms were notified by the CBDT by notification number 4, ITR 1 to 6 were notified by notification number 4 by 2023 on 10th of February, and ITR 7 was notified by notification number 5 on 14th of February. So how I've structured this for everyone's convenience is that we begin with the common changes. Firstly, we'll brush up with the ITR forms, who needs to file what form based on their income sources. Thereafter, we'll move to certain changes that have been common to multiple ITRs so that we can address go to these changes and applicable to each ITR. Thereafter, we slowly move on to other changes which is specific to a few ITRs, say ITR 6, and then we'll quickly run through ITR 7, changes in ITR 7. So to begin with, the forms that are used to file the income tax return. So firstly, we have ITR 1, known as such, a very basic, simple form that can be filed by only individuals being ordinarily resident and having a total income of only up to 50 lakh rupees. Only those individuals can file who have a salary, income from only one house property, and income from other sources. So in case they have profit or gains of business or profession or from capital gains, they are not allowed ITR 1. Then moving on, ITR 2 and 3, as you're aware, individuals and Hindu undivided families. The major difference between these two ITRs is having business income. In case a person does not have a business income, then it's ITR 2. And in case they have a business income, they need to file ITR 3. Thereafter, we have another basic return, ITR 4, that is Sugam. This is mainly for the individuals being ordinary resident or the HUF for firms except LLPs who have opted for the presumptive income scheme and having a total income of up to rupees 50 lakhs only. Here again, Everyone can file the returns here, provided they fall under the presumptive income scheme, except if they have capital gains. They need to file ITR 3. Then we have ITR 5, which can be filed by the other class of people, that is other class of person, that is association of persons, body of individuals, LLPs, and any other artificial juridical persons. Then we have ITR 6, which are generally filed by companies, business trust, who are not required to file under any other provisions of the Act as per 139 subsection 4E. Or you have investment funds under section 115 UP, again, who are not required to file under any other sections of the Act. Then finally, we have ITR 7, which is majorly used by all the religious or charitable trusts, political parties, research association, venture capital funds, mutual funds, etc., and other universities or colleges or educational institutions. So with this out of our way, mainly where we know who needs to file what ITR, we'll move on to the major changes that have been brought in to these ITRs. And just for everyone's information, I would take up the Q&A sessions. I can answer all the queries in the end of the session, so that at one stage we'll finish all of this. At the end of the session, we'll take the Q&A. So moving on. One of the biggest amendments that we had in the Finance Act 2022 was the introduction on taxation of virtual digital assets. Now, the Finance Act 2022 had introduced section 115 BBH, where any transfer, any gains arising from the transfer of VDA was taxable at the rate as 30%. And further, there was no set-off of losses that were allowed. In pursuant to this amendment, Schedule VDA has been inserted into ITRs 2, 3, 5, 6, and 7, wherein this is a new schedule where specific disclosures has to be made with regard to the date of acquisition, the date of transfer, head under which this income needs to be taxed, whether it's the business income or the capital gain income, then the cost of acquisition, consideration received on transfer of such VDAs, and income from transfer of VDAs. As mentioned here, enter nil in case of losses. So as you are aware that the section clearly mentions that there's no set-off of losses allowed, even intra-head, that is, even if you have made any losses from any transfer of VDA, even that cannot be set off with the gains. So whatever gains that has been made on absolute terms tax needs to be paid on the same. Now, there are certain ancillary changes by introduction of this Schedule VDA in various other schedules, which we'll look upon now. To begin with, we have Schedule BP, the Schedule Business of Profession. There's a modification in the income receipts or credited to P&L, where section 115 BBH has been added. Here, the income from transfer of such VDAs needs to be disclosed, which is net of cost of acquisition. So only that needs to be disclosed here. Accordingly, even on the expense side, any expense that has been incurred on such transfer or such transactions, other than cost of acquisition, needs to be disclosed here. Then we have Schedule CG. Now, again, item number B of Schedule VDA, the same needs to be disclosed here. Income from transfer of virtual digital asset, again being an ancillary by introduction of Schedule VDA. So a small change in Schedule CG. Thereafter, this specific disclosure is for information about accrual or receipt of capital gains. This is mainly for the computation of interest under 234C, where quarter-wise details of the accrual or the receipt of capital gains on transfer of VDA needs to be disclosed here for appropriate computation of interest under section 234C. Thereafter, again, a small change in the income chargeable to tax at special rate, that is Schedule SI. So by virtue of introduction, whatever of Schedule VDA, whatever changes that we have in Schedule BP or Schedule CG, the same needs to be disclosed here. That is, what is the income that has been disclosed under head business or profession in Schedule BP, or under the head capital gains, the same needs to be disclosed in Schedule SI. Again, an ancillary change in computation of total income, where the capital gain that has been charged under this section has to be separately disclosed in Part B of Schedule TI. Then we have the Part B of tax payments. Now, along with the introduction of section 115 BBH, section 194S was also introduced, wherein it was mandated by to withhold taxes on whenever a person is responsible for paying any consideration for transfer of a VDA to any resident, they were required to withhold a tax of 1% on such transfer. Further, so after withholding of the taxes, the deductor needs to provide Form 16E to the seller. Now, for the seller to claim this credit, whatever has been withheld by the deductor, the schedule TDS has been amended to include Form 16E that has been furnished by the deductor, so that necessary TDS can be claimed on filing of this return. So these are the major changes that we had, mainly with regard to the virtual digital assets. Moving on, this is with reference to section 153C. Now, this is applicable for all ITRs, ITR 1 to 7. 153C is basically assessment of any other person, wherein if a search is conducted and any valuable item or documents or any information has been found by the department is pertaining to some other person, then the assessment can be done under 153C of that other person. With Finance Act 2021 had introduced a sunset clause that whenever a search has been conducted after 1st of April 2021, assessment under 153C was not possible. Therefore, in Finance Act 2000 for AY 2022-23, this checkbox of filing the return under 153C had been removed. Now, the department has realized that there may be a possibility that the search has been conducted prior to 1st of April 2021, but the assessment under 153C may still be pending or yet not be done. To facilitate that, they have reintroduced this checkbox, wherein if any assessment that is being carried out under 153C, the same can be ticked under the general information from ITR 1 to 7 for all ITRs. Moving on, this is again a important change that has been brought in with regard to, so this again dates back to 2021, where there was an amendment in section 80G, wherein rule 18AB was introduced, wherein certain category of donees were required to file Form 10BD, listing out all the donations and everything received during the year, especially for the charitable trusts who were qualifying for the 50% deductions. They're required to file a form with the department listing out all the donations that were received by them with certain details. And accordingly, they were also required to give a certificate, hand over a certificate to the donors in Form 10BE, certifying that the so-and-so donation was received by such institution. And it is easier, and accordingly, the donor could have claimed the deduction under Section 80G in their return. Pursuant to that, there is this amendment which has been brought in, wherein the donor needs to disclose the ARN, that's the acknowledgement reference number, along with against each donee, which will be available in the Form 10B that has been handed over to them by the donee. Again, this is applicable to ITR 2, 3, 5, and 6. Moving on. Now, this is a transfer of TCS credit to another person. For this, we'll need to move to Section 5A of the Income Tax Act, which talks about the Portuguese Civil Code. So people, mainly the spouses domiciled in Goa, they are governed by the Portuguese Civil Code, wherein they fall under the system of community of property, where the spouses inherit the 50% property of the other spouse, and accordingly, the income is also shared between them. Now, whenever there was a common pool of income that was accruing to them, there was an issue with regard to claim of TCS credit by such taxpayers, where the TCS credit is only lying in one name. So the IT department generally matches the TCS claim as per the ITR of the 26 years. And in case of any mismatch, the taxpayers had to provide a RICO to the department. Now, to overcome this situation, the TCS has been amended, the schedule has been amended, so that the CPC has enough details to correlate the PAN and the amount of the other party, of the other spouse, wherein it will be easier for both the spouses to file the return and match the TCS credit, and to ensure that appropriate TCS has been claimed. So as evident here, there are new columns that has been introduced in the scheduled TCS, that TCS credit relating to self or other person or spouse as per Section 5A. What is the PAN of the other person? What is the financial year? Whether in whose hands it is being collected for the current year, And accordingly, these columns have been introduced to ensure that the whole process of claiming the TCS, especially on income which is forming part of the common pool, is convenient for both the taxpayers. Moving on. Another small change where it has been made mandatory for the foreign institution investors and the foreign portfolio investors to disclose their SEBI registration numbers in the general information while filing ITR 2, 3, and 5. This is mainly brought in to ensure transparency and accountability with regard to each FII and FPI, wherein easily the tracking mechanism can be enabled. Thereafter, this is the disclosure on income on which Section 89A relief was claimed in the prior year. This was an amendment brought in by Finance Act 2021, wherein it is applicable basically to residents who have been non-residents earlier, basically people who were employed outside India in the earlier years and they have moved back to India. So when they move back to India, they might have separate bank accounts in the notified country, wherein the retirement benefits might be still accruing or they are yet to be paid. So this had led to a jeopardy to such taxpayers where Indian tax law used to tax it as and when the income was accrued, and the other notified countries would have taxed it at the time of repayment or at the time of redemption. Now, this led to the issue for the taxpayers to claim FTC as the amounts were taxed at two different periods. To bring in relief to such taxpayers, the department had introduced Section 89A in Finance Act 2021, wherein they had given an option to such taxpayers to offer this income as and when it is taxed in such notified countries, maybe which is generally at the time of withdrawal or redemption. Now, and they are also required to file Form 10EE to give effect to this. In this particular ITR, there's an additional line item that has been added, that is the last row that we have here, where such taxpayers needs to disclose what is the income that has been already taxed during the previous year, under which relief under 89A was already claimed in any of the previous year. This again being applicable to ITR 2, 3, and 4. This is another important change that may be applicable to a lot of taxpayers. This is with regard to Section 115 BAC, the new tax regime that we have for individuals in HUF. Here, the department is seeking for exact details of the year of opt-in, of the year of opt-out, along with details of the date of filing and acknowledgement number of Form 10IE. So as evident here, this is, they're asking whether have you ever opted for the new tax regime under 115 BAC in any of the earlier years? If yes, then they need to provide the date of filing and the acknowledgement number of Form 10IE. Thereafter, if they have ever opted out of this regime, then they need to furnish this information along with the same year. Now, as evident, it is only applicable to ITR 3 and 4. So this is mainly for people who are having business income, and as the section mentions about people having business income can only opt in and opt out once in their lifetime. So pursuant to that, these details are sought by the department. Thereafter, we have the option where the taxpayer needs to disclose what is their option for the current assessment year, whether they are opting in or they are not opting it at all. They are continuing under the same tax regime, or are they opting out, or they are not eligible to opt in as they have opted in and opted out once in the earlier years. So with all of these details, the department will have information with regard to the new tax regime that has been opted by the people having business income. Thereafter, we have another change that might have a wide impact is turnover from intraday trading is now specifically sought by the department in ITRs 3 and 5. So basically, they're asking for two main details. That is, one is being the turnover and what is the income from such intraday trading. Now, as we are aware, intraday trading is considered as speculative and is taxable under the head profit and gains of business or profession. And for the purpose of computing the turnover, the sale consideration of all the transactions is not considered. What we need to consider is the profits on absolute basis and absolute profit basis. So basically, whatever is the profit, whatever is the losses that are incurred by the taxpayer needs to be aggregated, and on absolute terms, that forms part of the turnover. Same needs to be disclosed in the Part A trading account. So turnover along with the income from intraday trading, which has been transferred to P&L account, needs to be disclosed here. Now, this again can be mainly a move wherein going forward, this might form part of AIS, where the department can take this information from the brokerage houses, and thereafter this can be matched. Might be a possibility. Moving on. Now, we have certain specific changes which are applicable only to single ITR. That to begin with, we have ITR 1. On the 7th proviso to section 139 provides that any person who are otherwise not liable to file the return, if say for instance their income is below the maximum amount not chargeable to tax, they'll still be required to file the return in case they have certain expenditures or conditions that have been listed out in this proviso, such as if they have deposited more than 1 crore in one or more current bank accounts, or they have spent more than 2 lakhs on their foreign travel, or they have spent more than 1 lakh on electricity. So such taxpayers were required to file the returns even if they had their income below the basic exemption limit. From AY 2023-24, as evident, this was the requirement in AY 2023, where they could file ITR 1. Now, this particular row has been removed in AY 2023-24, wherein, so which means people, taxpayers who were filing return by virtue of having deposits in the current bank accounts in more than 1 crore, they are no longer eligible to file ITR 1. They need to file the other ITR 2 and 3, however it's applicable to them based on the income that they have earned. Moving on to ITR 3, another small change, a tweak done wherein the advances in the balance sheet, the breakup needs to be provided, wherein the advances has been received from related parties or unrelated parties. The breakup needs to be given. What is the breakup of these advances? Then we have ITR 5, additional disclosure requirement in case by a firm in case of change of partnership. Now, so whenever there was a change in the partnership firm, the members or the details of the members had to be given clearly. Now, there are 2 additional columns that has been introduced in this table, wherein along with the name and whether what is the change in composition, the PAN of such member needs to be disclosed. And along with that, what is the remuneration paid or payable in case of retiring partner? This is especially in case of a firm. And this is mainly flowing out from section 45(4), where the capital gains is taxable on retirement of a partner. So this, again, the department is seeking information specifically from the firm to disclose it in their ITR, the remuneration payable to the partner. We have ITR 6, a few changes in ITR 6, a very cosmetic change that has been brought in. In AY 22-23, as you can see, there was a checkbox for self-occupied house property. A company cannot self-occupy a property being an artificial person. Therefore, this has been removed in AY 23-24, where it's only let out or deemed let out. And in cases of such house properties, they've also introduced a column for the specific country that they need to disclose for Schedule HP. Thereafter, this is with regard to section 115 BBD. This section was introduced long back, wherein the domestic company, whenever they had received dividend from the foreign company, especially in which they had equity of in excess of 26%, the same dividend was taxed at the special rate of 15%. Thereafter, in Finance Act 2022, the DDT was abolished, wherein the dividend received even by domestic companies were taxable in the hands of the shareholders at the applicable rates to them. So to bring in parity between this and section dividend received from foreign companies, the Finance Act 2022 had inserted a sunset clause in this section, wherein this will not be applicable from AY 23-24. Accordingly, the ITR has brought in this change in ITR 6, wherein Schedule OS and Schedule SI, the disclosures pertaining to section 115 BBD has been removed as it is not applicable anymore. So these were the major changes that we had from ITR 1 to 6. We are moving on to ITR 7. That will quickly run through the major changes that we had. There are quite a lot. Let me tell you, there are quite a lot of changes in ITR 7. So I'll try to quickly run through the major changes that are there in ITR 7. So to begin with, there is in the general details where the regular registration or approval has been granted, the details of provisional registration or approval are not required to be disclosed anymore. Under Part A, again, general members information, So the members, whoever, in case of any person who is not an individual, then the beneficial owners, the natural person of who are beneficial owners of such person, they need to, earlier they were only required to give the details of such natural person as in the date of application. Going forward, it's only they need to disclose if such persons were members at any time during the previous year. Moving on. Taxpayers need to specifically disclose whether provisions of 22nd proviso to section 1023C or section 1310 are applicable to them. This is again a newly introduced proviso where any institution or trust who loses their exemption for whatever reasons as listed out in the Act, then their tax needs to be computed by giving effect to this proviso and this section, wherein they can claim only deductions based on the conditions highlighted. For example, if they are making expenses out of the corpus that has already been considered as exempt in the earlier years, the deduction of the same cannot be claimed. Or if they had purchased a capital asset in the earlier years, which has been treated as application, the depreciation on the same cannot be claimed. Now this, in Part A, general information, as well as in Schedule TNI, the ITRs are seeking specific information whether these provisions are applicable to such taxpayers, and the same needs to be ticked and accordingly needs to be filled. Moving on. So 11.5 generally lists out the modes that are allowed for the purpose of accumulation or set apart for the purpose of claiming exemption. Under section 11, the specified modes are generally the bank accounts or the savings certificate, post office savings account, unit trust of India. So now going forward, under the Part A balance sheet, the forms are seeking for specific breakup of the investment made in modes as specified under 11.5 and the investment that are made in modes other than specified under 11.5. Thereafter, Schedule I. This is with regard to details of amounts that were accumulated or set apart within the meaning of section 11.2. So 2 new columns has been added here, basically amount taxed in any earlier assessment years or balance available for application. I'll just elaborate this in the next slide, where the details of amount taxed in any earlier assessment year, that in column 6, a new schedule has been inserted where complete details has been sought for. So a schedule IA, this is introduced for details of accumulated income whichever has been taxed in any of the earlier years as per section 11.3. Now, section 11.3, now generally an exemption is allowed to a trust for whatever accumulation they make in excess of 15%, subject to certain conditions that has been specified in the Act. Section 11.3 provides for circumstances when the exemption provided to such on such applications ceases to be such on such accumulation, or whenever they are set apart or they are not utilized for the intended objects, then the same is taxable in the year in which such conditions are not fulfilled. In this new Schedule IA, the details needs to be given by the taxpayers that in the year, for which year of accumulation, what is the tax amount that has been taxed in the subsequent 5 years, if any, for whatever conditions that were not met. And accordingly, these conditions, the amounts needs to be disclosed here, which will further be reconciled or tallied. The complete details will be given in Schedule I. On similar lines, we have Schedule D. Schedule D is generally for the deemed application of income under clause 2 of explanation 1 to subsection 11 to subsection 1 of section 11. Again, 2 new columns being introduced here, that out of the deemed application amount required to be applied, and what are the amount that are taxed in any of the earlier assessment years. Here again, column 5 is related to a new schedule, which is a Schedule DA. So the details of accumulated income taxed in any of the earlier years as per section 11(1)(b) needs to be disclosed here. So this is basically, so whenever a charitable institution or trust, they cannot utilize 85% of its income for the charitable or religious purpose, it shall be deemed to be applied for such purposes on filing of Form 9A by reasons in 11(1)(b), basically if, in explanation 1, wherein to section 11(1), wherein the amount has been accrued but not yet received, or there are any other reasons. In that case, it is considered to be deemed as applied. Now, in the year of receipt, if the same is not applied, then it will be considered as income in the year immediately after the year in which it was received. and accordingly it will be taxable under section 115 BBI, again a newly introduced section by Finance Act 2022. Here, so in similar lines with Schedule IA, what is the year of accumulation, whether it's prior to financial year 17-18 or the respective years, and if any of those which were considered as deemed application has been taxed in the years after that, the complete matrix needs to be given here by the taxpayer. Thereafter, insertion of a new schedule 115 BBI. So as evident here, the first two line items are the total of column 15 of Schedule I and the total of column 8 of Schedule D. So this was a new section that was introduced by Finance Act 2022, which provides that where the total income of any charitable institution or has includes any specified income, then they shall pay tax at a special rate of 30% on the aggregate of such income. So this schedule has listed out these special incomes that can be taxable, and accordingly the taxpayer needs to disclose the amount that has been earned by them in such category. Thereafter, a few changes that are made in Schedule J, details of investment of funds, statement showing the funds and investment and the last year. So other few changes, a couple of new columns. So opening balance, the corpus not applied till 31st March 2022. The total amount invested or deposited back into the corpus, and the amount taxed in assessment year 2022-23. So this is mainly flowing from one of the amendments that in Finance Act 2021, it was clarified that the application from corpus, or if a loan has been taken for application of funds, then it can be only considered as application in the year of repayment of such corpus or loan. So with effect from 1st of April 2021. Thereafter, what happened was, people who had withdrawn before prior to that date and they had already claimed it on withdrawal. Thereafter, whenever they are repaying, this had led to whenever they're repaying, they're again claiming as application. This was leading to double deduction. So the recent budget Finance Act 2023 has rectified this anomaly, and this is probably in lines with that. Thereafter, we have Schedule R, a new schedule which has been inserted to reconcile the corpus, basically a reco of corpus that is required mainly between Schedule J, as we just saw, and the balance sheet. So what is the closing balance as on the last day of the previous year, as per the Schedule J and as per balance sheet? And what are the reasons for difference needs to be highlighted, whether it's for the purchase of asset, depreciation, or any other reason, the same needs to be specified here. Thereafter, modifications are made to Schedule VC, that is voluntary contributions. Earlier, the schedule had to be filled in for virtue of domestic contributions and foreign contributions. Now, this amendment has been made where these contributions needs to be disclosed other than anonymous donations taxable under 115 BBC. So all the anonymous donations that are taxable will require a separate disclosure, and this voluntary contribution will have amounts other than those anonymous donations. Thereafter, we have modifications made to Schedule 115 TD. Now, accredited income under 115 TD was earlier, the Finance Act 2022 has extended the provisions to Section 1023 institutions as well. Earlier, it was only 12AA and 12AB. Accordingly, the accredited income under such section, if applicable, is exemption cleared under so-and-so section. Also, they need to disclose. Thereafter, modification made to Schedule LA. Now, this is mainly applicable to political parties, where earlier it was not mandatory for them to provide the registration details of the recognition by the Election Commission of India. Now, they need to mention whether they are recognized by the Election Commission of India, and if yes, what is the date of recognition? The same needs to be mentioned by the political parties. Thereafter, moving on, this is the last change for ITR 7, wherein a new schedule has been inserted, that is Schedule A, basically the amount that has been applied to the stated objects. This has been introduced to replace Schedule ER and EC. The Schedule ER and EC mainly were the schedules which again were serving the same purpose for the amounts applied for the stated objects for various other, for all the institutions that were covered in ITR 5. So for the sake of convenience, the two has been merged and a single schedule has been released, where the complete details of revenue, capital, and the total amounts that are applied needs to be disclosed. So with this, we have majorly covered all the changes that are applicable to all the ITRs from 1 to 7. I'll quickly take you through the key changes that were there majorly in ITR 1 to 6 for a summary. So here, as we had seen, there was insertion of Schedule VDA and related amendments that were ancillary to Schedule BP, CG, TI, etc. After that, the ARN of donation, especially eligible for 50% deduction, needs to be disclosed, which is available in Form 10BE. Transfer of TC is made more viable, especially for people covered by Section 5A of the Income Tax Act. Disclosure of SEBI registration is made mandatory for FIIs and SPIs in the general information. Relief to taxpayers enabling claim of FTC arising due to timing difference for taxation of retirement between India and foreign countries. So here the notified countries that are currently notified are US, Canada, Britain, and Northern Ireland is the currently list of 4 countries that are notified. After that, we have additional disclosures for people opting in for 115 BAC, majorly having business income. Thereafter, disclosing intraday turnover is a new addition where people indulging in intraday transactions need to disclose the turnover and the income. Individual depositing more than a crore in current accounts cannot file ITR 1 anymore. Additional disclosure relating to the partner in case of change of composition of the firm. And finally, we have exclusion of Section 115BB, that is special tax rate for dividend received from foreign companies. The same has been excluded from Schedule OS and SI. So with this, we have covered all the major changes that we had in the ITR for AY 23-24. So yeah, that is it. Thank you all of you for patiently hearing.
Yeah.
Over to you, Abhishek.
Yeah. So we have a question. I'll read out.
Yeah.
In case of father and son, agreement was made for sale of property when father was alive, and the buyer has deducted TDS on father's PAN. Later, the father passed away. By way of will being left, behind, the property has now been moved to son's name. Later, at the time of actual registration, the buyer has deducted the balance TDS on son's PAN. As son being the rightful owner now, is declaring the entire sale transaction and declaring the capital gains. As the TDS of father and son falls under 2 different assessment years, if the correction is initiated for TDS of father, then TDS of father will come and sit in son's PAN for the assessment year for which the assessment is already completed. Question is whether the son can claim the transfer of TDS from father's PAN by way of Section 5A or Rules 37BA, Subrule 2, in current AY without doing the TDS correction.
Okay, this is a pretty long one. I'm just reading the second aspect again as the TDS funds is already completed. Now, this is something that 5A again, what I had covered was mainly for TCS. This is something that I'll need to specifically check in Rule 37BA, and I'll need to get back. It is something that I'm currently not sure of.
Okay.
I can surely get back to you, Abhishek, with this answer for this.
Sure. Once you share, I'll share it with all the participants. Sure. So, also, this with respect to 12A and 12B, that is intraday trading. So some of the participants had the query with respect to why there are 2 reporting clauses under 12A and 12B, and they just want you to just highlight the what has to be reported in these 2 rows.
Sure. So In 12A, what we have is the turnover that needs to be computed. This is basically as I had mentioned about the absolute profit basis, where all the profits as well as losses needs to be added, and that forms part of the turnover. Now, this is the income from trading that has been transferred to P&L. Now, when transferring the income to the P&L account, we will not follow the aggregate basis, and it will be the net income that has been transferred to P&L after all the transactions of plus and minuses. So this is the major difference between these two, where it needs to be disclosed, where what is the income, as this will be separately considered as speculative and taxed accordingly. So the amount transferred to P&L is what 12B contains. However, 12A is the turnover.
Okay. Okay. Any other questions from participants? Yeah. So we have another question. Some assessees have small intraday transaction with few thousands. Do they also have to file ITR 3, or they can show the profits under other sources?
Now, lawfully, the intraday, without considering the quantum, is considered as speculative, and it is taxed under PGBP as it is considered as speculative clearly. Now, but practically there has been situations where, I mean, that's again not part of this forum that I can say, but lawfully speaking, no, it has to file ITR 3 only.
Okay, okay. We will share the slides, means for the other participants who are asking questions. We'll share the slides, it's not an issue. Anything else? Okay. So thank you, Ashish. We will close the session here. So we have an upcoming session on 28th of April. It's on salary taxation. We will attempt to revisit some of the forgotten and neglected provisions under the head of salary. We will also discuss the new taxing structures, plans, and common misconception errors which we have seen in salary taxation. So we will post the registration link online on KSCAA.com, and hope we will see you there in the next session. Okay.
Thank you so much, Abhishek, and thank you,
Yeah.
Team KSCAA.
Thank you, Ashish. Yeah.
Thank you.
Thank you. Thank you. Bye.